Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, let's get into today's episode, and I wanted to talk about housing affordability and probably the rhetoric that we'll be faced with next year, because it seems like we'll have a federal election in May. In fact, we've got to have one by the end of May, and I'd imagine the current government's going to push it out as long as possible. But of course, in every federal election campaign, housing affordability tends to be a pretty hot topic. And unfortunately, there seems to be more talk than action and effective policy change. But I thought it'd be interesting to reflect back on, this housing affordability issue, what can be done to solve it, and most importantly, if some of those actions are taken with the guise to solve this housing affordability issue, how does it affect long-term property investors, particularly those that are investing in investment-grade locations? I think that's a really important question to ask. So I just want to draw this distinction between this podcast isn't about how we're going to solve housing affordability. It's more about what are some of the potential solutions to solve housing affordability. And if they did occur, should you change your investment approach, or how will it impact existing investments? And I think it's really good to think about, because I don't think that there's an easy fix here. And I actually think, irrespective of what the government does, the idea behind investing in investment grade property will still have great merit. So I wrote a blog a few years ago talking about all three levels of government. So that I'm talking here federal government, state governments, and local governments rely on the property market for a substantial amount of tax revenue. Some studies have suggested that government taxes and charges account for around about 30% of the cost of new housing. Some of those reports suggest it's even higher than 30%. So, if you want to build cheaper new housing, the government is a large contributor towards the cost, and therefore they could be, if they wanted to be, contribute a substantial amount to reducing the cost of new housing potentially. And then, of course, if we look to state governments and we're looking at stamp duty and land tax, those revenue sources make up somewhere between 1/3 and half of all state revenues. That's almost uniform sort of across the board. So rising property prices really tend to translate to rising tax revenue. And so governments have kind of got a vested interest in making sure that, our property prices don't fall, certainly, but in fact, if they continue to rise at the pace that they have historically, that's actually going to be good for the government. And if they were successful in solving this housing affordability issue, and success would look like falling property prices, really, and that has, wide-reaching impacts. I'm sure that helps first home buyers, but falling property prices tend to impact consumer confidence, business confidence, and therefore business and consumer spending. And then in that situation where there's a complete lack of confidence, you're most likely to enter a recession or even a depression. So I'm not sure that, we can solve the housing affordability crisis in inverted commas in isolation. But anyway, if they did, it's not going to serve the government. So we've got to ask ourselves, particularly during an election campaign, how dedicated are they really to solving this problem, given they're relying on the property market for a lot of tax revenue, and how much is sort of rhetoric and window dressing and all those sorts of things. Anyway, putting that point aside, because I think it's an important point, putting that point aside, let's talk about, some of the potential solutions that have been proposed or sort of are currently in implementation. So if we look to the Victorian government, it announced plans for 50 high-density activity centres, they call them, across Melbourne, and they've already announced the first 25 of these activity centres. They'll be strategically located near trains and tram stations, mostly in the city's southeast, with the goal of delivering around about 300 new homes by 2051. So that's kind of their goal. And Sydney has a sort of similar plan. In 2018, they announced a urban planning initiative and designated 15 urban renewal corridors, that's what they call them, for revitalisation. And that plan, back in 18, plans to accommodate 725 new homes by 2038. So the overarching goal of these two plans, both in Victoria and New South Wales, or I should say Melbourne and Sydney, the overarching goal is to increase density in areas that are already well serviced by public transport using a mixture of mid-rise buildings, which tend to be around 10 to 20 stories, and low-rise buildings, apartment buildings, which tend to be, 4 or fewer stories in those locations. So it's really about increasing density. Now, most of us on the face of it would go, oh, gee, we don't want that sort of density in the blue chip suburbs that we've come to really love for its character and lack of density, I guess, to some degree. And it's natural then to think about, how is that going to impact property prices and growth in those locations? And I'm not talking necessarily next door to a high-rise building, but I'm just talking, in the suburb. Well, Peter Tulip, who was a former economist at the RBA and has spent much of his career studying property price behaviour, Peter now works for an organisation called Centre for Independent Studies. And it's important to point out that this organisation is not funded by the government or the property industry, which I think, again, I like to highlight that because there's a lot of research and reports that the property industry funds, and of course there's a natural conflict of interest there. So completely independent, they receive funding from individuals, wealthy families, corporates, but looking through the donors and so forth, doesn't look like there's necessarily any undue impact there. Anyway, Peter and his colleagues studied the effects of high-rise developments in Sydney suburbs such as Chatswood, Forest Lodge and Green Square. And they found that property prices in these areas closely followed the trends of nearby suburbs, both before and after the developments, showing no significant negative impact in neighbourhood amenity. So his work sort of suggests that these tall apartment buildings don't really harm the character of the local areas, and the negative consequences of those tend to be over-exaggerated. So Tulip's work argues that there's no empirical evidence to support the idea that development reduces the quality or character of neighbourhoods. In fact, he believes that higher density development can actually foster economic growth and actually enhances local amenity without significantly affecting property values. So if we look at his research and there's a few bodies that have produced research, but as I said, a lot of them tend to be conflicted. I like Peter Tulip's work. I've followed it for many years, and even particularly when he was at the RBA. And so, I think it's good evidence to sort of show that, these NIMBYs, not in my backyard, people that sort of oppose development and greater density, maybe it can be done in a way that will still maintain the character of the neighbourhood, and ultimately it increases the productive land value, underlying land value, and that's obviously a positive attribute for that location. But of course, we shouldn't jump to too many conclusions in terms of the state's ability to actually increase density in these locations. Because what happens, speaking to some people in the property industry, what happens is they implement these planning laws and rules and so forth. Of course, the people that own property in the locations that can now be developed into high-rise start to think, well, okay, great, the value of my land's increased. And sometimes then they bandy together with their neighbours and say, okay, we can put our properties together and sell to developer. But quite often, and certainly has been the case in Sydney, the people have an unrealistic expectation of what their land is worth, and they want to sell it to a developer for something that's not really financially viable for the developer to buy. And it ends up in a bit of a stalemate. These people think, oh, well, we're not going to sell out because we think we've sort of won the lotto with this change in regulation. And developers are saying, well, cost to build and, selling these things off the plan, all those sorts of risk, we can't afford to pay such a high price for the land. So we can't always assume that whilst people might change the planning regulations, we can't assume that it's naturally going to change in terms of achieving that higher density. But I guess when you look at Peter Tulip's work, you would say that, okay, if we do have these activity centres, so-called activity centres, and we live in a suburb where that's going to occur, again, as long as we're not living next door to, a high-rise building, I don't think we as long-term property investors should be too worried about the potential impacts of that. Of course, the proof is in the pudding and it depends on the implementation. I'm sure they could mess it up, but, I don't think, looking at the evidence, I don't think we need to be too concerned. So that's one way to increase housing supply is by increasing density in already established suburbs. Of course, the other way to increase supply is build new homes. And because obviously there's some limitations to how much density you're actually going to achieve in some of these established suburbs. I think because mostly people are going to be against it, just generally against it. So, of course, we need to do probably both, which is increase density and also build a whole bunch of new homes. And given Australia has a huge, vast amount of land, of course, we've got the ability to be able to kind of spread out in terms of from our capital city perspective. However, one of the big challenges in spreading out as a capital city is we need the infrastructure to be able to support that growth. We need that infrastructure built on a timely basis and on a cost-effective way as well, which, Australia doesn't really, and particularly Victoria, doesn't really have a great track record for doing that. And particularly, for example, Sydney faces a unique constraint as well, being bordered by water and national parks. So a lot more difficult for Sydney to spread out as opposed to, say, Brisbane and Melbourne, for instance. So there's going to be greater focus on density in Sydney, I think, and then probably greater focus on the urban sprawl, if you like, in Melbourne and Brisbane and other capital cities. Now, in theory, if we went and built a whole bunch of new homes in the suburbs or bordering or on the outskirts of capital cities, in theory, I guess if you flooded the market with a lot of supply, prices could come down. But again, we go back to the infrastructure thing. So if living out in those locations means that there's a huge amount of travel time, less amenities in those areas and so forth, it's just not going to have the impact that I think it will. And there's a cohort of buyers that can afford to not have to go out that far as well. So I think infrastructure is a huge constraint. Of course, we'd be silly not to think about how technology might change that. So I was interested to watch a recent event by the US company Tesla, where they unveiled its Cybercab and Optimus robot. You can find that on the internet if you haven't seen that event that was held in Texas. I think it's really interesting, particularly the Optimus robot, really could change the world. But the Cybercab thing is interesting too, and, really thinking about driverless cars and how that might impact on, where you're living and property values and so forth. There's a business called Waymo One that already operate some cybercabs in some cities in California. So it's already happening over there. And I think it will hit Australian shores probably sooner than we think. Quite often when we hear about these new technologies, we think, that could be a decade or more away. But things tend to change really quickly. So it kind of raises the question, if you had to commute, for example, an hour and a half each way, so 3 hours a day, but you could use that time in your own vehicle to work or relax. I mean, you could have a Teams meeting, for example, on the way to work. You could potentially be just as productive as if you were actually in the office and have the comfort of your own vehicle and not need to really worry about the distance. So I think a technology like that, driverless cars, could certainly assist the government in not having to build as much infrastructure, I guess, in terms of public transport. And, it could suit some people, but I still think that there's going to be a draw to sort of inner city blue chip locations because proximity to work and travel time, schools, all those sorts of things are only one of the benefits that these suburbs tend to offer. Just the sort of unique vibe, community culture that these suburbs have established over many decades, is not easily replicable in outer locations. So I think there's a whole bunch of reasons why people want to live in inner city blue chip suburbs. It's not just travel time, but I think we've got to acknowledge that there will be technology over the next few decades that will make it a little bit easier, I think, to live further away from the CBD. So I think to sum up, Australia definitely needs to increase density in established blue chip suburbs. I mean, I think that's an irrefutable necessity. If we want to keep growing the economy, that requires population growth and we need to house these people somewhere. But I think also there's always going to be a level of opposition to increasing density. So I think the ability for us to do that in established suburbs is going to be really challenging. And I don't think the government's going to achieve the targets that they're looking to achieve. I think they'll make some headway, but I don't think it'll go anywhere close to sort of solving the supply issue. But even if it does occur, and to the extent it does occur, certainly there's evidence based on that empirical research to suggest it's not really going to harm property values. If anything, it could actually increase economic activity, increase the productive value of underlying land in those locations, and be a positive attribute for investors that already own property in those locations. And if we turn our mind to new housing, well, new housing tends to be in a new build area, has to be in a new build area, of course, which is not really in competition with established investment grade locations. locations. I mean, they're not the same product, if you like. They aren't attracting the same cohort, so it's not really a comparable issue. But infrastructure is going to be a major issue, and driverless cars could go some way or part of the way to solving that, but it's still not going to be the magic bullet, if you like. So I think when you sum all this up, it's all pretty good news for investment grade property investors, particularly long-term investors. I don't think there's really anything that the government could or will do that's really going to actually harm the property market. And that is that high quality properties will, I think, continue to command a premium and a premium capital growth rate into the future. And even more so, I've spoken about this a number of times in this podcast, that over the past number of decades, a rising borrowing capacity has contributed to kind of all ships rising, in a rising tide. But without a change in borrowing capacity over the next period of time, I think the performance between blue chip, outer property, there'll be a greater growth gap between those two markets, and those people that have invested in high quality property from an investment grade perspective will be well rewarded. Okay, let's get into some listener questions today. First question is from Tom. It's actually a very long question. I'm just going to sort of summarize it. Tom and his wife, they're both 36. They've got 2 children under 5. They live in a sought after suburb in close to Brisbane CBD in a 3-bedroom, 1-bath home, but they're kind of running out of accommodation. They're really thinking about doing a couple of different things. They could move a couple of suburbs over and get a much nicer home, as in larger home and newer, more modern and so forth. But, there's a longer sort of public transport commute, less walkability to amenities, those sorts of things. Or they could renovate their existing home into a 4-bedroom, 2-bath property. Wouldn't be as nice as moving, the suburbs over and getting the shiny and new one. But in fact, he says it's far less flashy, but could see them living there for another 10 to 15 years. And the third option would be making some sort of investment now, like buying an investment property for 5 to 600,000, doing it up, making some improvements, keeping it for 5 years, then selling it, and then hopefully extending their budget even further. So the budgets on the previous 2 options were about 1314, and he's sort of suggesting, well, maybe we could do this, create some equity, and spend something closer or just under 2 million. And then upgrade to a not only nicer home, but in the same or even a better suburb. And his question is, which one would you do and which one is most important? Well, of course, I've got to put the lifestyle considerations to the side, and I'll obviously just speak about the financial implications. He said he's a high risk taker, so investing in a property for 5 years, selling it, and then crystallizing the capital gain doesn't worry him. Look, I think that risk profile's a funny thing, right? Because you could say I'm a risk taker, but no one really wants to lose money. People want to take the best action that's in their long-term best interests. So I think quite often we confuse risk profile with doing something that's silly or not going to work versus really high risk. I mean, I think there are questions around risk profile in terms of like, okay, for retiree, how much money do they have invested in shares versus defensive investments? That's very much a risk profile question. But I would say that, and I've written about this previously, that I reckon most people have pretty much the same risk profile in that, and I reckon Tom does as well, in that he just wants to make the best decision for his family that's going to yield the best results over the next 10 to 20 years. So it's not really I'm willing to take the risk, it's just that's really the risk profile. I think it's a really important thing to understand, something I've really formed a stronger view on over the last 10 years, I guess, the more I deal with people and their decision making. So I acknowledge, Tom, you've said I'm a risk taker, but let's look at that as a strategy. Go and buy a property, keep it for 5 years. Hopefully you make a big capital gain that is actually going to materially change your borrowing capacity or your affordability, I should say, in terms of upgrading a home. I'm just not attracted to it at all. I mean, it could happen. I mean, you could do a small scale development. I'm not suggesting you do this because it's not for everyone. You need a certain skill set, need a certain amount of time to deliver. You need enough, you need the right contacts as well, which takes time and money to accumulate accumulate, but it's possible that, people do a small scale development in terms of buy a parcel of land, build 3 townhouses and sell them over the next 3 years, develop and sell. And then they might walk away and make sort of 20% deposit. They'll have to pay some tax and all those sorts of things, of course. That can work, but again, it's not really appropriate for most people. They don't have the skill, experience and network in order to do that effectively. Otherwise, I'm not really interested in going and buying a property with the intention of holding it for 5 years. I'd be happy to do that and say, look, I'm going to go and buy this property. I think it's going to work out in 5 years, but I'm also going to make friends with holding it for long term as well in case it doesn't work out. That could be a strategy. It's not going to really work for you, Tom, because your idea is to use the equity to help increase your budget in 5 years' time to upgrade. But that could be a strategy. But apart from that, unless you've got that fallback of saying, well, I'll hold as a long-term investment if it doesn't really work out, the 5 years is just too short a time horizon. Notwithstanding, so there's 2 problems here. You've got the entry and exit costs in terms of stamp duty and all the costs associated with going and buying an asset. And then you've got the exit costs, not only the real estate fees that you need to pay to sell the property, but obviously the capital gains tax that you're going to trigger. And, net of all those costs, how much profit is left over. And you only need the market to really turn against you to wipe out all that profit and just not make it worthwhile. Property is a long-term asset because the market can behave unexpectedly. So you can get a couple of years of no growth, even though you expected the next 2 years was going to be very strong growth, and therefore property is very much a long-term asset. And using it as a short-term investment, unless you're developing, which is a business, not investing, if you're going to use it as a short-term asset, it's a little bit akin to using a driver on the putting green. Use a putter to make that shot in golf. It's using the wrong club for the wrong shot in terms of making some quick money. So I'm not in love with that idea. If we compare I can move a couple of suburbs over, ultimately what you're describing is you're getting something that's a bigger home, a shinier home, a newer home. Of course, in that situation, what you're doing is spending most of your budget on the improvements and less on the underlying land value. Whereas if you improve your existing dwelling, you still maintain the land in the location that's more desirable than a few suburbs over. So clearly, if you look at it from a 10 or 15 year perspective, and I don't know the exact examples that you're contemplating here, Tom, of course, but I would have to say that the chances of renovating in your current home is most likely going to yield a better financial outcome. And then you've got the walkability and the amenity in the area. So I think if you overlay then the lifestyle implications, that's going to also improve your situation. That comes at a cost of not having a less flashy home, of course. So, there's a yin and a yang. There's 2 sides to every coin. But from a financial perspective, that sounds like the best way to go. When I'm contemplating this sort of advice for a client, the other thing I like to think, particularly if they're talking about upgrading to a much better home in 5 years from now, the thing I like to think about is I want to buy that asset today rather than 5 years' time, because there's no guarantees, but likelihood is that property is going to cost me a lot more in 5 years' time. And if it's a home, I've got to pay that additional cost from after-tax dollars. So, after I pay all the tax on my income and so forth, it's a costly exercise. So the better off I am to do it now rather than later. So the other thing that people could consider, and I don't know if the numbers work for you, Tom, but the other thing that people could consider is go and buy yourself the property that you really love or like, that you might want to use in 5 years' time, and put a tenant in it between now of the next 5 years. So you get the negative gearing, if you like, and then you can just move into that home in 5 years' time or when it's affordable to do so. That's been a strategy that's worked well for many clients in terms of getting a foothold in the market now, I guess hedging against, being priced out of the market in 5 years' time and still picking up some negative gearing benefits. That strategy works better for a property, or I should say works best, I think, for a property that, people want to get into a particular location. They'll buy mostly land value and think, I'll put a tenant in it and then we'll improve the property in 5 years' time before we occupy it. If you're going to go and buy a shiny brand new property, one of the concerns there with that strategy is that, of course, you don't want to put tenants in it and they ruin it, or you're not moving into a shiny new property anymore. But just something to think about. But really good question, Tom, and I'm sorry that my answer is so long-winded. Okay, next question is from Graham. I'll read it out, of course. Could you cover a little on strategies with industry super funds when you transition into retirement income flow. What I'm referring to is there are ways that you can take, say, the 4% minimum, that's the 4% of your balance as a minimum pension amount each year, which is what you have to take, but your super compounds at a higher rate than that. Say you earn, say, 6%, so you're not really eating into the capital. I would be keen for you to outline the benefits of a 3 to 4 bucket system, drawing your fortnightly payment from a cash bucket. This would be opposed to placing the whole lot in balanced, for example, investment option. What else would you consider to ensure the greatest longevity of your super balance? It's a great question, Graham, and I think a lot of people overcomplicate it. One of the benefits of going with an industry super fund and going with what they call a pre-mixed investment option, which tends to be conservative, balanced, high growth. I mean, they all go under different names, and actually you can't really compare two products without looking at the underlying asset allocation, because what one fund will call growth, another fund will actually call balanced. So it's actually important to have a look at, how much is defensively invested and how much is invested in growth assets. But in terms of the benefit of going, let's just say balanced for this example, and a balanced pre-mixed investment option is that you don't need to mess around with it. So one of the things I've seen people do is go, oh, look, I'll go 60% balanced and 40% growth. That's really not really very meaningful, because I don't think you can measure an asset allocation that accurately, that you need to use a combination of different asset allocations. And also, you're paying the super fund to manage that asset allocation. That's a really important decision that they're making, because you can't control markets, but what we can control is where your money is invested. And so that's a very important decision in terms of asset allocation. How much they have invested in different geographical markets, in different asset classes, and different sub-asset classes. So my advice would be, let them do their thing. Give them the greater scope to add value to a situation. Don't unnecessarily involve yourself by overcomplicating things. So my answer, Graham, would be to choose a pre-mixed investment option that is right for you, and then go 100% into that option. So whether that's, if you're a high risk taker, you feel like you've got plenty of assets and you can wear the volatility, well, you might be in growth. If you're, just in retirement and you really just can't stomach the volatility and you want to be a little bit more conservative and holding on to your money and preserving capital is more important than investment returns, then have a more conservative asset allocation, whether that's balanced or a conservative balanced asset allocation, which might be something like 30 to 40% of your balance is invested in defensive assets, and that will be, have less volatility. And then you don't need to worry about it. Then just draw your 4% pension from that. They will manage the underlying asset allocation in terms of how much they have invested in cash and all those sorts of things. And it's the asset allocation that's going to dictate whether there's any material volatility. But I actually wouldn't worry about I'll have this much in cash and this much in conservative and this much in growth. What you're doing then is taking over that asset allocation decision, which I think is a very important financial decision and one that you really want advice on. And so leave it to the investment committee. That there's a lot of robustness around those decisions, a lot of debate, a lot of analysis, more that you and I would do, by ourselves necessarily as individuals. I'm not talking about me as a financial planner at the moment. And so just you're paying them a fee, let them do their thing. And that's my answer. And that would be true for people going into retirement, but also true for people that, are still in accumulation phase as well. So if you're in your 30s and young, you've got plenty of runway left to retirement, go high growth. Ride it out. You ride the volatility. If the volatility worries you, just don't look at your super balance. But you look statistically, if you go high growth from 30s in your 20s, chances are, in fact, the highest probability of earning the greatest return and having the highest super balance by the time you get to age 60. Okay, next question is from David, and he's asked how investment bonds are taxed. I'm not going to answer your question, David, because I know that Campbell Wallace, who's a senior financial advisor, is filling in for me next Wednesday episode. He has a great episode that he's put together where he poses the question, how much capital growth do you need from an investment property, from a geared investment property, to make it a better investment than an ungeared share portfolio? So really interesting question. I think you'll enjoy that episode next week from Campbell. And at the end of the episode, I know he answers a question about investment bonds and how they're taxed and the benefits and all those sorts of things. So I'm going to leave that for Campbell next week to answer you. And in fact, I've run out of time today. So thank you very much for listening. If you do have any questions or feedback, you can send them to us at questions@investopoly.com. campbellwellesses.com.au. And I'll be back with you next Tuesday for another Q&A episode. And as I said, next Wednesday's episode, and for in fact the next 3 weeks, Campbell Wallace is going to fill in for me, and I'll do the Tuesday Q&A episodes right through the Christmas and New Year period. So, if you're bored of spending time with family and friends, at least you've got something to listen to take you through that time. So until next week, bye for now.